I'm running out of battery. Okie doke. So continuing on with depreciation. Now, we very well may take up the whole class period talking about depreciation today. We started last week. There's a lot to go over. And like I had mentioned, the concept of depreciation or the calculation of depreciation is done very differently for tax purposes and for financial accounting purposes. So we'll try and kind of take our time through this a little bit. Remember, we can take 2 more class periods on this chapter. So chapter 6 homework isn't due until next Thursday. So you've got this week off from homework, okay? So it gives you a little bit of time to work on your spreadsheets, homework. All right, so recall, we started talking about the fact that there are these 4 components of depreciation that we need to know in order to calculate depreciation properly for tax purposes. The first one, and we went through this, was basis, essentially the cost. But remember, the basis is a little bit different than cost because that basis sort of acts like book value in that it's adjusted for accumulated depreciation. Remember, adjusted downward for that accumulated depreciation over time, and it can be adjusted upward for any improvements as well over time. So basis basis is important, and when we get to chapter 7, we'll talk about basis again, because when we're calculating any gain or loss from the disposition of an asset, so if we sell it or get rid of it, we're allowed, if it's a business asset, we're allowed to take a loss if we have a loss, or we have to claim a gain if we have a gain. Basis is what we're going to use to calculate that gain or loss. So that's why it's important as well in the next chapter. So depreciation periods, what we're going to start out with today. These otherwise known as asset class lives. And again, the IRS makes this pretty easy in that they tell you what the asset class life is. And remember, there's no salvage value for tax depreciation. We're going to depreciate the entire value of the asset, and we're going to depreciate it over a period that the IRS tells us to use based on what the asset is. Okay, so we're going to go through that. Depreciation convention. Remember this? I mentioned that this one's probably the most foreign concept. This has to do with when we start depreciating an item, and it has to do with when we stop depreciating an item. And as I kind of gave you a preview last week, oftentimes, most times, we are not going to stop or start depreciating an item or stop depreciating an item on the actual day that we purchase it or on the actual day that we dispose of it. We just have a few choices that we can use. So again, it's a little foreign to us, but once we go through it, I think you'll probably find it pretty easy to understand, since we only have 3 choices of when we're really going to start or stop depreciating an asset. And then the last one is our depreciation method, which once again the IRS tells us what our depreciation method is, and the depreciation method is going to be based on the asset class life that we're using. So it's the different asset class lives will have different methods of depreciation. We're going to get through all of that, and then I'm going to tell you a couple of ways that the IRS allows taxpayers to write off assets 100% immediately. Okay, so there are some options for doing that, and a lot of businesses take advantage of it, but there are limitations on those. So we're going to get through all of this first, and then get through a couple of those exceptions where we're allowed 100% write-off immediately, and then we're going to talk as well about a couple of special types of assets, automobiles, and something is called listed property. So I'll fill you in on that when we get there. So let's, we got basis down, right? And remember, it's going to depend upon how we attained the asset, right? How we, most times we're going to purchase an asset, but there could be other ways that we attain it as well. We could inherit it. We could be gifted that asset. We could have converted it from personal use, which happens frequently, especially with rental real estate and that sort of thing. And so our basis is, how we calculate our basis is going to depend on how we acquired that, that asset. Any questions before we start talking then about, what's our next category here, asset class lives? Anybody? No? Okay. I think we went through those examples. We talked about the fact that even if you're buying a used piece of equipment, you do still get to depreciate it, even if it was fully depreciated by the other taxpayer, right? So you purchased it and it was used and it was been fully depreciated, it's worth nothing to them. Because what's going to happen is when they sold it to you, they're going to have to calculate a gain and pay tax on the gain for that asset. That gain then sort of transfers over to the new purchaser, and then they get to depreciate it from there. So that's why kind of the thinking behind that. All right, so depreciation periods or asset class lives. So first off, we have two different types of assets, business assets. We have real property. Oh, I don't like this marker. It's going to be hard to erase, I can tell. Oh, I'm sorry. I have a real, I despise the markers in the boards here. I'm sorry if that's hard to see. Real property. And we have what's called personal property.
Business assets?
These are business assets. These are only business assets that we're talking about. Which can be a little bit confusing because we got the word personal here, personal property. If we're talking about something we own personally, we're not using it in the business, we call that personal use property. So we kind of add that into the mix as well. But in this case, we are only talking about business assets. So we've got real property and we've got personal property. Real property is what it sounds like. It's real estate, right? So buildings and land, those are the two most common types, buildings and land. And those buildings could be, it could be residential if they're being used in a business, so like a rental business, that could be a residential type home, could be office space, could be warehouse space, anything like that that is used in a business. Land is land. We know what land is. And just like in financial accounting, we do not depreciate land for tax purposes. Then we have personal property, and this is essentially everything else. So some examples: furniture and fixtures, computers, autos, and so on and so forth. The list could be endless here. So we have this distinction between these two types of property. When we get to, I think it's, chapter 7, we're going to revisit this distinction, because in chapter 7 we're going to talk about what happens when we sell an asset. Okay? And it makes a difference. How we treat any gain or loss is different depending upon whether we have real property or personal property that we're selling. But that's just kind of a little preview. You don't have to worry about that really right now. So personal property, as I mentioned here. So equipment, that's another big one. I suppose we could put that up. That's a big category there. Personal property includes these, anything that is not real property, land and buildings, as well as any other structural components that are attached to the land. So think about structural, sheds, things like that. Anything that's attached to the land. Personal property is going to have a shorter useful life. It's not going to last as long. right? I mean, that makes sense. This is stuff that gets used regularly and gets eaten up, and so it's not gonna have as long a useful life. Whereas buildings and land, of course land, we don't depreciate it, so we don't really have a useful life for land, but buildings are gonna have a longer useful life, okay? So we are, for the most part, personal property, we're gonna use, so 3, 5, 7 years, depending upon the type of property. Real property, building, no depreciation, no, I don't wanna say no useful life because its useful life is indefinite, but no depreciation for land. Buildings, we have two different types of buildings. We have residential, and remember, it's only used in a business, so I'm not talking about my personal residence here. I'm talking about residential property that is used in a business, and we have commercial. We divide those two out because we've got two different class lives for those different types of property. Residential is 27.5 years. Commercial is 39 years. So for real property, you really only have to remember those two class lives. And again, the distinction is somebody living in it. Could be an apartment, could be a house, could be a duplex, could be a triplex, could be, any number of dwellings. If somebody is living in it and it's being used as business property, so I mean rent is really about the only time you would use it, then it's going to be depreciated over 27.5 years.
That number doesn't change at all?
Nope. It's always 27.5. Yeah.
And then does the depreciation happen when you buy it, or?
So we're going to get to that. That's the convention. When we start depreciating it, you mean?
Yeah.
Mm-hmm. We're going to get to that with the next section here when we start talking about the depreciation conventions. Okay. Commercial property, office buildings, warehouses, anything where it's being used in the business, and it could be a rental property as well, or it could, it could be something that is used actually, like a factory building, something along those lines. That is commercial property. That is going to have a 39-year useful life, always, okay?
You said it could be rental property though?
Yeah. So if the character of it is what matters. Like, if somebody's living in it, it's residential. If nobody's living in it, and both of these are being used for business, then it's commercial, okay? So like if this building, I mean, it's a nonprofit, obviously, so, but if we were in a business right now and this building was owned by somebody else and they were renting it out for our use, they would be depreciating it because they own it. They would be depreciating it over 39 years. If we owned it and we're using it for our business, we would be depreciating it over 39 years because nobody's living here. Let's hope nobody's living here. Who knows? So 27.5 and 39, like I said, the real property is pretty easy to remember. Personal property, for the most part, is going to be 3, 5, or 7 year life, and again, it's going to depend upon what it is. But then we also have, these other recovery classes of 10, 15, and 20 years, and they could apply to either real or personal property. We don't do much with those in this class, by the way. So you don't have to worry too terribly much about those. I can tell you that and when we get down here, you'll see what types of buildings and equipment they are that would be depreciated over that life, and you'll realize that they're pretty specific. The only one that would be used commonly in Iowa is this 20-year life, because that is for agricultural buildings. Agricultural buildings, obviously, they get beaten up a lot faster than other types of business property, right? Because for the most part, you're talking about livestock or what have you. So in Iowa, you're going to see that 20-year period quite frequently. But these are the ones, the most common ones that we are going to, I use the black one again, that we're gonna be focusing on. But again, we've got, yes,
Excuse me, if this property used for both sides, I want to take example, somebody have building, and then it's real property and personal property, what you want to figure out for years?
so they will never be, it's always gonna be split.
Okay.
It's always gonna be two different types of property. Now, it could be though that one piece of real property is being used partially for business and partially for personal purposes. And we're gonna talk about what happens when that is the case. So for example, you have a duplex. You're living in half of the duplex, you're renting out the other half of the duplex, right? So we'll talk about what happens as far as depreciation goes and income and expenses for that further on in the chapter. So, like I said, we've got this other recovery classes of 10, 15, and 20, which could be, I guess I'll put that in red, could be real or personal. So 10, 15, and 20 years. But those are our class lives. Rarely we've got some obscure ones, other ones, but for the most part, these are the most common. And the most common ones you're gonna work with in this class are 5, 7, 27.5, and 39. Okay, that's what most of your problems are going to focus on, are those class lives. But that's it. Like, there's no 25, well, there could be some 25 year. I shouldn't say there's no 25 year. There's no 1 year depreciation on anything. That's just an expense. There's no 47 year depreciation. You know, there's no 30 year depreciation. You look at what the property is, and the IRS tells you how long you depreciate it over. Okay, so you can, and you'll see why we really don't use a lot of these very often. 3 year property, racehorses. Do you know you could depreciate racehorses? Less than 2 years old and certain specialized industry tools. 5 year, automobiles and light trucks. Obviously those are very commonly used in businesses. Computers and peripheral equipment. Peripheral equipment, monitors, printers, that sort of thing. Which 5 years is a pretty long time. I mean, and especially in a business, they don't really last that long usually. 7 year, furniture, fixtures, and equipment. Equipment being, if you have a construction business, a bulldozer would be a piece of equipment. You know, a widget machine, making machine, anything, you know, in manufacturing, those are pieces of equipment. Furniture, tables, chairs, all of that stuff. It's gonna be depreciated over 10 years. Over 7 years. 10 year, vessels, barges, tugs, and fruit or nut-bearing plants. So you can tell. And obviously these would be regional, right? So you might see that depreciation life more in, so vessels, barges, tugs, I don't know, Florida maybe, and the fruit or nut-bearing plants, Florida, Arizona, that kind of, you know, wherever they have that for businesses. 15 year, wastewater treatment plants and telephone distribution plants. Okay. Don't see that very often. Those are obviously specialized. Here we go, 20 year, farm buildings. So that's where we would see that a lot in Iowa. 27.5 years. So again, 3, 5, 7, personal property. 10, 15, 20 could be considered personal property, could be considered real property. So like a wastewater treatment plant and telephone distribution plants and farm buildings, those are real property, right? Vessels, barges, tugs, fruit or nut-bearing plants, those would be probably more under personal property. So that's why they say it could be either or for those class lives. 27.5 years. So here's where we get to our real property lives. Residential real property, apartments. Again, if somebody can live in it, or is living in it, I should say. If somebody is living in it, and it's a business property, then it's going to be residential, it's gonna be depreciated over 27.5 years. This 31.5 year property, this is being phased out. We stopped using this asset class life back in 1993, which is 30 years ago. Whew, 30 years ago. But this is a 31.5 year life. So it is possible that there is property still out there that was placed in service probably, 1992, 93, that's still being depreciated, that's still using this 31.5 year life. But it's being phased out. So once we're past 31.5 years from that date, we're not gonna use that anymore at all. For your purposes, you're not gonna use it, okay? So it's being grandfathered out. It was replaced by 39 year.
So technically, like after 25, that'll be uprooted.
After, so after 2025, that'll be done.
Okay.
Yep. And you wouldn't see very many buildings out there anyway, because remember, this would be when it was acquired.
Right.
It could have been resold after that, and then it's gonna be depreciated over the new asset life,
Okay.
right? So you would have to have purchased it before that date, close to that date, still be within the depreciation period, and you never sold it. Like you still have it, okay? It was replaced by 39 year property. Well, I shouldn't say it was replaced by, they changed the law to extend the depreciation period for non-residential property to 39 years. Think about this for a second. So this was back in 1993. Obviously, this law was passed May 13th, 1993. If you're depreciating something over 31.5 years, as opposed to 39 years, what is the depreciation expense difference gonna be between those two? So if you've got, and we can use an actual calculation here if you like. Say we've got an asset that was $100,000, and this is just kind of so that conceptually you understand when they change these depreciation, these asset class lives, it changes tax revenue. It has a big effect on how much revenue the government is bringing in, and so they'll use that as a way. And most people don't think about that. Businesses think about it, but most ordinary taxpayers don't think about the fact that that's going to change the revenue. So it's a great way for them to kind of hide some tax increases or maybe some tax decreases, and people don't really notice. In this case, would it have been an increase or a decrease?
Increase.
Yeah, increase, exactly, because our expense every year is going to go down. So if we were 100,000 divided by 31.5 years versus 100,000 divided by 39 years, I can't do that in my head. Somebody can do it for me. So this would be the depreciation expense per year.
For 39,
439?
no, for 39 over there. For 39 years,
For 39 years, yeah,
yeah, 2,564.
$2,564.
And then for 31.5, it's $3,174.60.
So the expense over 31.5 years was $3,174.60 versus when they changed it, now the expense is $2,564. So, it doesn't seem like a lot, and we're talking about taxable income. So this 31.5 year property life was giving a larger depreciation deduction than the new 39 year property life. So essentially, it's a tax increase, right? Now, over time, ideally it's gonna be the same amount because you're just spreading it out, but this brings in more money sooner right? Or I'm sorry, this brings in more money sooner because it's a smaller expense. Does that make sense to everybody? I know it's kind of, it's a smaller number, so we automatically think, well, smaller numbers, that's smaller tax, but what I'm talking about here is the expense part. So I just want you to understand that conceptually, and again, that's not really part of the text, it's not really part of there's no test question on it, but just so you understand kind of on a deeper level how that all works. Okay, so that's it. I mean, you've got a chart that can tell you what the depreciation life is, the asset class life, and so it's pretty easy. You don't have really any decisions to make with regard to the class life. Any questions on it, though? No? Okay. We can move on. That's really bad. So that's something you'll, like, maybe some of your problems you are gonna need to like reference this to see, oh, is this a 5-year property or 7-year property? After a while, it just kind of becomes natural to you that you sort of know what each is. Okay, so these depreciation conventions. Oh, you know what? I'm gonna put these into sections.